Investing in index funds helps you reach vital investment goals and enjoy financial freedom. Hello and welcome. I am Prarthana from Clear, India's largest tax and financial services platform. At Clear, we have assisted 6 million tax filers so far. If you have not already, do subscribe to our channel to support us. Index funds are passive mutual funds that mimic a stock market index. Stock market indices represent the entire stock market or a market segment. In India, the NSE Nifty 50 and the BSE Sensex are popular stock market indices representing the performance of the overall stock market. Nifty 50 comprises 50 of the largest and most liquid stocks on the National Stock Exchange of India. The BSE Sensex comprises 30 of the largest and most liquid stocks on the Bombay Stock Exchange of India. The index fund manager invests in the same set of stocks that are part of the stock market index portfolio in the same proportions. The index fund performs in tandem with the stock market index it tracks. For instance, index funds tracking the Nifty 50 give returns similar to this index. There are many stock market indices in India, and you can track the appropriate index based on your financial goals and risk tolerance. For example, investors who want to invest in mid-cap stocks invest in index funds that tracks the Nifty Mid-Cap 150 index. Market-savvy investors can choose sector-based index funds that focus on certain sectors such as banking, IT, healthcare, etc. The table is showing the difference between actively managed fund versus index fund. Do note, higher mutual fund expenses, cash balance and problems in buying or selling underlying index stocks are the causes of tracking error. Always pick index funds with lower expense ratio and low tracking error to get returns similar to the index. Index funds are vulnerable to tracking error, which is the difference between index fund return and the benchmark returns over time. Index funds are ideal for first-timers as many actively managed equity funds have underperformed their benchmark indices. You can at least get matching returns as the benchmark index if you invest in index funds and attain your financial goals. Many large cap funds have failed to outperform their benchmark indices over the past 2 years. While this is too short a time to judge their performance, index funds tracking the Nifty and Sensex have done well recently. Here are the benefits of investing in index funds.
Number 1. Lower expense ratio of index funds means that you can save on research and stock trading expenses. Number 2. The fund manager sticks to the investment mandate and does not have to research and pick stocks, thereby eliminating investment bias. Number 3. Benchmark stock market indices like the Nifty 50 and Sensex are diversified across sectors and industries. Number 4. Stock market indices represent the best performing stocks and weed out underperformers, thereby building a strong, well-rounded portfolio. Number 5. As more investors enter the Indian stock market, they will develop their Western counterparts. It means almost all stocks are well researched, giving few opportunities to earn market-beating returns. The focus shifts to index funds, which earn returns matching the stock market. Lastly, you must stay invested in index funds for 10 or more years to grow your wealth. Here are the parameters to pick the best index funds. You must choose index funds with lower expense ratio and tracking error to get returns matching the benchmark index. Make sure the tracking error is around 0.06% to 0.15%. Pick index funds with AUM of over Rs 500 crore to manage sudden redemptions by large investors.
The takeaway is you can invest in index funds that track the Nifty 50 and BSE Sensex to build a broadly diversified portfolio across sectors and industries. I hope by now you have understood how to pick the right index funds. Comment clear if you are clear or drop your questions if any. Don't you want to know the best index funds to get to your financial goals? New investors can opt for index funds that track either the Nifty 50 or the BSE Sensex. There is a huge overlap between the portfolio of Nifty 50 and the Sensex, and you get similar returns over the long term. Firstly, HDFC Index Fund Nifty 50 Plan Direct Plan Growth. It is an open-ended mutual fund that tracks the Nifty 50 index. The fund invests 87% of its asset in giant companies and 13% in large companies. It has generated a CAGR, that is compound annual growth rate, of 18.04% over the past 3 years. It has exposure of around 35% towards financial services and 19% in the technology sector. The fund has an expense ratio of 0.2% where risk is very high and Morningstar rating is 3. Number 2, ICICI Prudential Nifty Index Fund Direct Plan Growth. It is an open-ended mutual fund that tracks the Nifty 50 index. The fund invests 87% of its assets in giant companies and 13% in large companies. It has generated a CAGR, that is compound annual growth rate, of 18.19% over the past 3 years. It has exposure of around 35% towards the financial services and 19% in technology sector. The fund has an expense ratio of 0.17% where risk is very high and Morningstar rating is 3. Number 3, UTI Nifty Index Fund Direct Plan Growth. It is an open-ended mutual fund that tracks the Nifty 50 index. The fund invests 87% of its asset in giant companies and 13% in large companies. It has a CAGR of 18.19% over the past 3 years. It has exposure of around 35% towards financial services and 19% in the technology sector. The fund has an expense ratio of 0.2%. The risk is very high and Morningstar rating is 2. Number 4, HDFC Index Fund Sensex Plan Direct Plan Growth. It is an open-ended mutual fund that tracks the Sensex. The fund invests 96% of its asset in giant companies and 4% in large companies. It has generated a CAGR of 18.17% over the past 3 years. It has exposure of around 39% towards the financial services and 22% in the technology sector. The fund has an expense ratio of 0.2%. The risk is very high and Morningstar rating is 3. Number 5, ICICI Prudential Index Fund Direct Plan Growth. It is an open-ended mutual fund that tracks the Sensex. The fund invests 96% of its asset in giant companies and 4% in large companies. It has generated a CAGR of 18.27% over the past 3 years. It has exposure of around 39% towards financial services and 22% in the technology sector. The fund has an expense ratio of 0.16% where the risk is very high and the Morningstar rating is not rated.
HDFC Index Fund Nifty 50 Plan Direct Plan Growth has given a CAGR of 17.14% and has AUM of Rs 4434 crore with an expense ratio of 0.2% and tracking error of 0.1%. Secondly, ICICI Prudential Nifty Index Fund Direct Plan Growth has given a CAGR of 16.99% and has AUM of Rs 2,438 crore with an expense ratio of 0.17% and tracking error of 0.14%. Thirdly, UTI Nifty Index Funds Direct Plan Growth has given a CAGR of 17.21% and has AUM of Rs 5,841 crore with an expense ratio of 0.20% and tracking error of 0.11%. Fourthly, HDFC Index Fund Sensex Plan Direct Plan Growth has given a CAGR of 17.85% and has AUM of Rs 2,915 crore with an expense ratio of 0.20% and tracking error of 0.06%. Lastly, ICICI Prudential Sensex Index Fund Direct Plan Growth has AUM of Rs 451 crore with an expense ratio of 0.16%.
Index funds are ideal for first-timers in equity investments to get market returns without much risk and attain long-term financial goals. It is a low-cost investment as the mutual fund does not incur expenses of a research team. Top stock market indices like the Nifty and Sensex incorporate stocks across different sectors, helping you build a diversified portfolio. This video shows you index funds for new investors in 2022. You will find curated lists of other packs like MaxTax, Saver, Better Than FD, Bold Wealth Builder and more to meet your financial needs on the Black app. Please click on the link that is provided in the description to download the Black app and explore other investment options. Subscribe to our channel to get clear explanations of financial services and concepts. Thank you so much for watching the video. Take care.